Hey everyone, I'm Jeremy Szafron. You're watching Kitco News. Don't forget to hit that subscribe button. Now today on the show, U.S. equity markets have surged to new heights, yet beneath this explosive growth, there's a significant concentration in just a few tech giants. Is it the Magnificent Seven or is it now the Magnificent Three? This week, Nvidia raced past Microsoft and Apple, becoming the world's most valuable company with a market cap of $3.34 trillion. Highlighting concerns about market stability and potential market bubbles here. But it's not just stocks that are on the move. Gold and silver have also had a notable uptick, breaking past resistance levels and maintaining prices as central banks ramp up their purchases, continuing to reflect deepening geopolitical tensions and inflation worries. So what does this mean for your investment strategy? Let's unpack it. Let's welcome back to our show Will Rhind, founder and CEO of GraniteShares, which manages over $6 billion in assets. Hey, Will, great to see you again. Welcome back to the show.
Thank you, Jeremy. Great to see you too. Good to be back.
Yeah, there's a ton to talk about, but let's start off with the economy here. I mean, recent economic data shows some troubling signs. There's a slight contraction in consumer spending and an unexpected dip in core inflation. Will, how do you interpret these figures? Are we seeing early warning signs of a downturn, or is this just a temporary hiccup?
I think it's a little too early to say some early warning signs of a downturn, but of course, what the market has been responding to most is the inflation numbers. And of course, we've had some better than expected numbers coming out recently, most notably the CPI, which came in a little bit softer than the market expected. So inflation seems to be coming down, which is amplifying the narrative of providing some room for the Federal Reserve to make those first either rate cut or rate cuts before the end of the year.
Okay, now we talked a little bit about those economic indicators. What are some potential risks and opportunities that investors should be watching for in the coming months here? You know, it's not this typical sell in May and go away strategy here this year. It seems like there's a little bit more to pay attention to.
Yeah, that's right. We're in a slightly unusual situation where if you sold in May, then you'd definitely be hurting right now with the market, racing to new all-time highs. As you mentioned, Jeremy, a lot of that has been driven by AI and one stock in particular. So you're right in commentary, the Magnificent Seven has become, maybe even the Magnificent One, which is Nvidia, of course, has been the story of this year, the story of last year, and kind of a bit of a moment of history, I think, in terms of it's not always we get to see a stock that goes in a fairly short period of time to become the world's most valuable company. So a bit of history in motion here.
Yeah, it's been pretty wild to watch. I mean, as we talk about the equity markets, we've seen the S&P 500 hitting record levels. And as you mentioned, it appears that it's kind of concentrated in these few tech giants. Talk to me about what this bubble potentially looks like. I mean, it's a market. It's cyclical. We know what goes up must eventually come down. Is that the case here? Are we just over-evaluated on this AI hype? What are we dealing with?
The interesting thing about the AI sort of hype is that when it comes to Nvidia in particular, and I would argue that other companies are in the same boat, particularly companies like the AMDs and the Taiwan Semiconductors of the world, is that they're posting revenue numbers to back it up. So it's not like we're saying that AI is some sort of amorphous concept that in the future might be realized in the form of massively increased revenues for Nvidia, et cetera. It's happening now. And what's interesting is that the large technology companies have such power, both in terms of market cap, both in terms of free cash flow, in terms of their specific position of strength within their sector. And they're using a lot of this power to purchase, in the case of Nvidia, GPUs from Nvidia, and these sort of core elements of hardware to drive this AI machine forward. So it's interesting because it's not really the case that you can say that, unlike the tech bubble, which of the late 90s, which of course gets a lot of comparisons, that as we found out, a lot of that was really built on fluff. Whereas this time around, these are the world's most valuable companies and they're spending big on AI. And that's obviously manifesting itself in the rise in Nvidia.
Yeah. So is this revenue just starting here, Will, for some of these companies? I mean, you mentioned some of the picks and shovels giving their money back to Nvidia, that makes sense. We're starting to see the revenue go up. I mean, crazy numbers, in fact. But how does this skew market capitalization within the distribution, within the broader market here? I mean, it seems like it's just going back to that one stock.
That's right. I mean, you've got a huge rebalance that started for one of the largest technology funds in the market, and that was the Spider, the State Street Sector Spider Technology Fund, where the rebalance would put Nvidia at a weight of I think around 20% of that particular sector. And you've got some commentators, albeit very bullish commentators, talking about a scenario where Nvidia could represent upwards of 10%, maybe even 15% of the S&P 500 itself. So kind of phenomenal potential scenarios here if Nvidia continues to grow at the rate it's been growing on the back of this surge or frenzy of demand for AI.
Right. Well, we talked a little bit about diversification. I mean, you've certainly noted before that it's key in portfolio management. Looking at the current market dynamics, how should investors adjust their strategies to mitigate risks associated with such a concentration in these few stocks? I mean, what are you advising here?
Well, I think the market is risk on, and so the right thing to do is keep an appropriate amount of equity risk at this stage. However, Jeremy, the gold market is staying very resilient at these prices, and of course, gold and cash historically have been the kind of go-to diversifiers. Cash is still attractive to people, in an environment where you can still earn 5% on cash or short-term treasuries. That's attractive, as well as gold, clearly, as a diversifier. But I think, we start to see some movement, particularly in the gold market. For that to happen, I should say, we need a little bit more fear. And I think at this stage in the market, there's not enough fear really to propel gold materially higher than where we are today.
Yeah, that's interesting. I want to get to gold here in a second and including a forecast, but I just want to go back there because you kind of mentioned it when we look at the U.S. market. I mean, there's a lot of people that are watching consumer spending saying that spending is down. The stimulus is finally starting to dwindle out. I'm curious what you're seeing. I mean, is the U.S. investor, average U.S. retail investor, are they sitting on the cash or are they investing it in this market?
I think they're investing, but again, it sort of depends on who you talk to. So there's no doubt that there is big, participation in this market. But one of the bull scenarios for increased market performance from here is there is an enormous amount of cash still on the sidelines, and that cash is happily earning 5% at this stage. But if the view is that interest rates are going to fall by the end of the year, and that cash, those yields are going from 5% to 3%, for example, there's a lot of people now suggesting that, hey, you should get out of cash into the market, in a scenario where you've missed out on, a huge amount of gain already year to date in terms of the equity market. And like I said, you're absolutely right to point out the retail sales numbers, Jeremy, that they did, come in a little bit weaker than the market expected. And there's no doubt that we've seen some stress in restaurants or area of the restaurant market, particularly in areas like California, where the minimum wage was hiked up to $20 an hour. So there is some strain that we are seeing, and that obviously will continue to play out, but it's not yet weak enough to signal, I think, a broader sell-off as we've seen, from the market performance, writ large.
Yeah, absolutely. It sure is. Seems to be piping away here. Okay, let's turn back over to commodities. I mean, you got a lot of expertise within metals, particularly precious metals. Talk to me about the recent surge in gold and silver prices. I mean, central banks continue to be net buyers of gold, and we know what's kind of driving this geopolitically, the inflation concerns. But, Will, how sustainable is this trend, and what does it say about the role of precious metals in this strategy of the current global economy?
Well, I think it is sustainable, certainly for gold. Let's talk about gold first. I think it's sustainable in an environment where gold prices have just been so resilient in the face of potentially, traditionally a lot of news which is negative for gold. In other words, positive real interest rates, or certainly interest rates as high as they've been, for the decades now, in an environment where gold is not a yielding asset class, of course. But the thing that perhaps has taken people by surprise is we have some geopolitical, risk in the market. And I think there's a premium in there for what's going on in Israel, Gaza, what's going on in Ukraine with Russia. There's highlight or heightened geopolitical tensions. And again, talk about central bank buying, that continues to be resilient. But I think the Chinese market, again, has caught people by surprise in that the softness or the weakness that we've seen in the Chinese real estate has translated into strength in gold. And perhaps, Chinese investor moving away from, first choice investment in real estate and putting that money into gold has really helped support the market here.
Yeah, we've talked about it before, Will. There's been a lot of people that kind of understood hedging a bet about inflation here, and they started to pick up some Bitcoin. And it almost seems like that younger generation starting to look at gold and silver. Are you seeing this? I mean, in this current market, are there specific factors that might be, worth advising here? What do we do with the allocations, I guess is my question.
So honestly, Jeremy, the market's been a little bit slow for us in terms of, allocations into gold. So our gold ETF bar, we haven't seen much activity really starting from the beginning of the year. And I think that largely speaks to the fact that gold investors tend to be more defensive. And in an environment where equities are running, that has been the trade, so far this year, where people are allocating perhaps the majority of their wallets for investment. I think, as I mentioned briefly earlier, for us to see more flows into gold, I think we're going to need a ratchet up in the fear factor. And the fear factor around markets, particularly the US market, just isn't here at the moment, just not here in any way, shape or form that is powerful or potent enough to get people, out of the equity market and into gold. So, perhaps we might see that, later on this year. But again, it's going to have to take some kind of shock, I think, that is really going to surprise markets. So I need to see a bit more fear in the market, I think, before we start seeing gold. And as for silver, silver's rally, I think, is in part, a nod to the market dynamics for precious metals changing from a pro-cyclical market which favors gold to a counter-cyclical market that favors gold to a pro-cyclical market that favors silver. In other words, interest rates are coming down, that giving manufacturing, broadly speaking, a boost, which helps demand for silver.
Okay, what's your forecast on the gold side? I mean, as you mentioned, it's been quite the year. We're sitting around that $2,300 mark, and it seems like there's some new footing here. We went from that 18 to 23, some stabilization happening in the market. What's your forecast here, Will?
I think that under the assumption that we do see at least one rate cut this year, I think another $100 on the gold price, so nudging past the all-time high, is possible again before the end of the year. Maybe even we see 2,500 before the end of the year. But I think for that to happen, like I said, we've got to have some surety that interest rates are on their way down, and of course the dollar is on its way down. If the dollar's falling, I think gold could rise from here, certainly to a new all-time high, maybe even 2,500 by the end of the year.
Interesting. How much of this is fundamentals driving the market? U.S., at least the central banks really haven't been picking up any gold buying. I'm curious, when you look at the market and it's flipped over here, is this more, how do we cut through the noise?
I think it's a mixture of both. So the fundamental elements are there in terms of central banks are buying. We know Chinese retail are buying, and certainly there's demand from countries that are experiencing their own issues with, could be currency controls, it could be rampant inflation within those economies. So we're seeing demand for gold absolutely at the fundamental level. And also on the jewelry side, bear in mind, we still have, a strong economy at the moment. And typically when we see a strong economy, gold is almost treated or seen as a luxury item and therefore can be purchased, from the jewelry side. I think we do see some weakness on the investment side where, in terms of coins and bars, that market has slowed as prices obviously have reached, at or near all-time highs. ETF demand has slowed again as the market has reached this sort of elevated position. I think for that to pick up again, we need to see an increase in that fear factor to motivate people to buy.
Yeah, Will, are you watching any of the equities on, say, Newmont or any of the big miners on the larger caps here and wondering when those precious metal prices will, catch up to the equities, or has that been done?
I think the challenge has always been the challenge that, has existed previously, which is that the mining sector, the biggest issue they have has been able to control their costs. And, when you have, inflationary costs, rising faster, or costs rising faster than inflation itself, that creates an issue. And that's why we've seen, attempts of some of the largest mining companies to buy each other's production or merge with each other, as a solution to the other big issue, which is that, finding new large deposits or significant deposits of gold is very difficult and very expensive. And it's easier or perhaps more efficient just to buy out somebody else's production. And, that's really, the scenario that we've seen, certainly in the larger cap mining space, will continue going forward, I believe.
Yeah, well said. Okay, let's look forward towards the year. I mean, obviously, it's an interesting year. We have upcoming elections in many countries, including the U.S. We just saw Europe flip politically, and the markets have been a little bit uneasy over there. I mean, you have $6 billion under management. What are you watching this year for, and what should investors be paying closest attention to?
I think in terms of the macro environment, it's all about the inflation trade, and particularly with interest rates and how that sets up for the end of the year. Because a large part of the equity markets and every asset class, I should say, the reason why they're priced the way they are is around interest rate inflation expectations. I'm not sure that necessarily the political environment will affect the market that much. If anything, if you go by historic performances, then typically after the US presidential election, that tends to be a positive year for markets, and particularly if an incumbent gets reelected. So I'm not sure that there's going to be too many issues around markets. If anything, I think change could be viewed as positive from the market perspective, but I think it's much more about the macro environment when it comes to what the central banks are doing.
Yeah, well said. Will Rhind, founder and CEO of GraniteShares, joining us today. Thanks again for making time. I know it's a day off for you over there, and good luck watching the game. Thanks, Will. Appreciate it.
Absolute pleasure. Thank you, Jeremy. Always good to talk to you.
You as well. I'm Jeremy Szafron. For all of us here at Kitco News, thank you for tuning in. Be sure to subscribe if you haven't already. We got lots of great content to come. We'll see you next time.